For more on the markets, I want to bring in Mona Mahajan. She's the head of investment strategy at Edward Jones. What do you think? What do you think between what's happened in the bond market, rattling folks a little bit, but then Jamie Dimon's comments? I don't know. Where do you want to go here?
Yeah, look, we've moved pretty far, pretty fast. 20% rally off that April 8th lows. We still have to digest a potential tax bill on the horizon, potential trading negotiations with China and non-Chinese trading partners. Could we get bouts of volatility in the weeks ahead? Absolutely. We know we don't move in a straight line higher indefinitely. But all that being said, we are seeing somewhat of a better setup as we head towards the back half of the year, potentially a Fed that is still poised to cut rates, albeit modestly. We have tariffs that could be, or at least have some more clarity on tariffs for CEOs. And then, of course, we are looking at potentially better policies around taxes and deregulation as well. So earnings growth, we think, could reaccelerate.
So are you fully invested right now?
So we would say we were fully invested through this period. We like to stay invested. Were we diversified? Absolutely. That's the difference, I think. We were not seeing what we saw in the last couple of years, which was a very concentrated market. We think the diversification across asset classes, cap sizes, regions.
Okay, so what do you want? But what do you want to be in and what don't you want to be in? Talk about being diversified.
Yeah, absolutely. Look, we continue to like here in the U.S. large cap and mid cap stocks, by the way. From a second,
but not small caps.
Small caps, we still are a little bit more cautious on
because of the credit story.
They're more leveraged. They are more exposed to exactly that. They have more exposure to higher yields potentially, but also they're less positive earners in the small cap space, more positive in the mid cap space. And mid-cap and small-cap, by the way, more leverage to domestic revenue as well. So we like that, not as exposed to tariffs. And now we also like what's been happening in the markets. Pro-cyclical parts of the market have been working. So it hasn't been this recession-proof defensive. So the market is kind of picking up on maybe we will be able to avoid this recessionary environment going forward. So we like pro-cyclical areas. Financials continue to stand out to us.
Is the only difference here? I mean, the stories all seem fairly the same. The tariffs are the big difference. We went from very high tariffs to at least a stand down for the moment. But the only difference is we were looking at the market way cheaper than it is today.
That's a great point. Look, we came into the year, we were
very highly priced at the beginning of the year.
We were highly priced. Valuations have come in, especially in the most highly valued parts of the market, which has been a good story. The tariffs, though, I think they, even at 10% plus, it's a pretty high tariff rate versus any time in history. So
did we rebound too much?
Yes. And, we were already on this path of we were growing at 2 to 3% above trend growth. This year was probably already going to be a year where we softened a bit. So the tariff story, I think, solidified that. We still don't see that recessionary environment because the consumer is hanging in, the labor market's hanging in. So to your point, everything was going on track, and maybe the tariffs softened it.
I guess there's two things. Market valuations we're watching very closely, and that same old Washington playbook that we've been dealing with for decades, which is you can juice the markets and the economy by holding this up. Are the markets saying, maybe not, we've seen too much because we're worried about the deficits at this point? Like that, it's maybe not going to be accepting the same old playbook that we always get from Washington.
Yeah, look, I think we are getting closer to that point. We certainly saw that the Treasury market throw a little bit of a tantrum earlier this year. Adding $4 to $5 trillion to the deficit. What does that do to yields? Look, we're at the high end of a 10-year Treasury, closer to 4.5. We were nearing 5% on a Treasury yield. All that being said, though, I think the U.S. economy has held in there because growth and productivity comes out of this economy. And we've seen that all the Mag 7 are housed in the U.S. We've historically had, even through periods of high deficits, innovation, productivity, economic growth and earnings growth drive the way forward. And we think that does continue here in the U.S.
Do you have no worries about some kind of serious bond problem? I mean, we were talking in the 6 o'clock hour about if the bond market sort of blows up in some way we haven't thought about.
Yeah, look, there's always that risk. But what we'd say and what we've seen is this is the deepest, most liquid market in the world. And by the way, it is the most regulated. So people feel comfortable holding U.S. bonds still. What I'd say is that 4.5% and even 5%, if you're close to retirement, in retirement, need income, this is a pretty good value still. So that gives us comfort. We like the idea that there will still be demand, even, despite some of the weakening foreign demand. We think pensions.
What do you tell people about crypto? Jamie Dimon is now selling crypto.
Yeah, look, we still find it speculative.
Or Bitcoin, I should say.
Yeah, Bitcoin. Yeah, we find it speculative. It's hard to value. How do you know if 90,000 is a fair value? You don't know how to, model the cash flows, discount them, et cetera. So that's where we stand as well. There's a lot of good ways to make money in this market. We've seen that in a 20% rally in the S&P. So holding equities, holding bonds, being diversified and balanced, that we think still holds a lot of water for investors.